Our two panelists today need little introduction. First, we have Mr. Jeffrey Sherman, who's been with the team for over 18 years and serves as Deputy Chief Investment Officer and Portfolio Manager for multi-sector and derivative-based strategies. Mr. Gundlach is our CEO and founder of DoubleLine Capital, which just celebrated our 10th anniversary. We are now managing over $150 billion in AUM. If you didn't catch his January 7th Just Markets webcast, he laid out his thoughts on the markets for 2020. Hopefully we'll hear some of those today. They're also available in the lobby on his thought leadership piece. He also hosted the Roundtable Prime discussion that I mentioned earlier, which can be viewed on DoubleLine's YouTube channel. Our moderator today is Mr. Sam Lau. He's a strategist on the Fixed Income Asset Allocation Committee and a contributing member of our global macro committees, where he provides macroeconomic and sector commentary. Mr. Lau is a portfolio manager of DoubleLine's strategic commodity strategy while working in portfolio management and trading for derivatives-based and multi-asset strategies. His research has contributed to the development of DoubleLine's smart beta strategies, including the Shiller Enhanced Cape and Shiller Enhanced International Cape, along with DoubleLine's strategic commodity strategy. Mr. Lau is also the co-host of The Sherman Show. So without further ado.
Thanks, Barb, and good afternoon, everyone. I have the pleasure today of facilitating what I think promises to be a very exciting, lively, and informative conversation between the two gentlemen on stage here today. The game plan for me today is to wind these two up and let them really just run on their own, and just knowing the two as long as I have, there's no shortage of good thoughts between the two of them, and they are generally thought of as some of the two of the great thought leaders in our industry today. In terms of the flight path, we're going to spend the next hour or so with this conversation, and then we do have set aside about 30 minutes or so for audience Q&A. And I would encourage everyone, if you do have questions that come up, please write them down so you don't forget them later for the Q&A, and save those questions for that 30-minute segment. So with that, I'm going to jumpstart this conversation here with a broad topic around the U.S. economy. The U.S. economy has enjoyed a 10-plus year period of slow, steady, positive growth in the longest expansionary period that we have in our recorded history. My question to the two gentlemen here is, what has been driving that? Can it continue? What's going to derail it?
Sherman?
Jump ball.
All right. The simple answer, if you have to use one word, debt. Debt is what's driven almost all of it. You've probably seen some of our charts from our webcasts that I like to troll out a lot too, showing the expansion. And we give it a little bit of credit. We start in 2006, get to the tail end, so it doesn't just start at the crisis. But if you look at the expansion of our GDP in nominal terms, so that's counting the inflation side, it's been more than 2.5 times. The debt burden has been about 2.5 times what the GDP growth rate has been over that period. And it's getting worse. It's not getting worse than the 2.5x. But our expansion that we're having, and if you kind of count the beans up from last year, it's probably something close to roughly 4.5% would be nominal GDP. Take about a 2% growth rate, roughly 2-3 inflation or so, and you're going to get something close to 4.5%. But the debt burden grew north of 5%, almost 5.5% when you look at that. And so it is an expansion, but it's an expansion that's being pulled forward through this debt burden. And that's just the public sector. Those are just looking at the amount of debt burden we have as a public society. It doesn't bring in corporate debt, doesn't bring in household debt. So it has been good times, as Sam pointed out. It has had a pretty steady growth rate, and it's been a trend line growth rate around 2.2 to 2.3 in real terms. Right. And what you see is that that's called the greatest economy ever. Right?
It's very strange the way American society has chosen to view success or good times. It's one of these things where when the retail sales data comes out, or savings rate data comes out, or consumer borrowing data comes out, it's really interesting how the happy faces show up on financial media when the borrowing is a very strong month of borrowing. So you can have retail sales that go up by like 0.4, and they'll say, but consumer borrowing went up by 0.7, and that's really good news because it means that the consumer is feeling good. But that's kind of a perverted way of thinking about the world. I mean, I'd like to tell the story. If you're walking down the street and I go, hey, Vince, I haven't seen you since Dartmouth, which is true. One of my friends from Dartmouth came in from Indianapolis for this. Vince, how you doing? And Vince goes, oh man, Jeffrey, I am crushing it. I have a house with a 100 LTV mortgage. I got a silent second for another 20% that the bank doesn't even know about. I have 4 credit cards all maxed out. I borrowed 50 grand from my brother-in-law for this watch. So I am living large. Oh, I feel like such a jerk. How are you doing, Jeffrey? And I go, I've got no debt. I've got a huge amount of savings. Yeah, my house is all paid for. I guess I'm sort of sucking. I mean, because right? But what is so great about a month of ever further indebtedness? And you hear it's very common. I've heard this for decades in this industry. Well, the consumer is 70% of the economy. So if the consumer, just stop right there. 70% of the economy being consumption is great if you're also producing. But it's not. We're not producing. We're consuming, and we're consuming a lot of goods. The trade deficit that Donald Trump vowed to put on tariffs to shrink hasn't shrunk. Trade deficit's been going up. We're basically borrowing money, vendor financing. I don't go shopping very often, and I had an occasion to go into, I think it was Target, for the first time in like years, and I just couldn't believe how cheap all the stuff was. It was unbelievable. We were buying plates and knives and forks for this house that we remodeled in Buffalo. And we had this cart all full of stuff, and I go to the counter and check it out. Of course, every single thing was made in China, like every single item. And you check it out, it's like $93. And I couldn't believe it, It was so society is functioning on this vendor financing, which underneath the surface, there are so many things in our global economy, in our world today, where things work in the short term, but they end up taking you to a very bad long-term end destination. And I think, borrowing money from China to buy their junk is great for the quarter and for consumer spending and for the economy and for keeping inflation down.
Well, do you remember back in 2013, we ran the first $1 trillion deficit, and Obama and that administration was castigated for doing so. That it was, oh my gosh, there's all this bad stuff going on. The Fed was actually buying bonds on the balance sheet. It was very similar, as we pointed out. But now, when we started talking about the tax cuts, and at the end of 2017, it was, okay, forget deficit neutrality. It had to start with, over 10 years, it can't cost more than $1 trillion. That was the new kind of Tea Party kind of stance. And so,
well, just like the definition of stable prices is 2% inflation.
Right. Well, it's because they can't slip to the downside. Then we have this vast thing. But yeah, I agree with that. And so it's that we've changed kind of the psyche where, you think about last year, the popularity of MMT, the modern monetary theory, deficits don't matter. It's the thing that we found that the only way to really continue growth in actual terms is to borrow money. And so it becomes status quo.
We've also added something to the fact that we're borrowing money, and that is we're also buying our debt through the Federal Reserve.
Right.
And that's another thing that I think goes into the short, dealing with the short term, but it ends up having a unknown consequence that's probably not very friendly in the long term. Just like negative interest rates in Europe, which are designed to kind of keep things going along.
Right, but also the key about buying our debt, it's not just that we're buying it, it's that we actually magically get to finance it at zero. We've created the zero coupon bond out there, not one that's issued at a discount, because the Fed rebates Treasury back all those borrowings too. So it's this other little silent way of financing things where by the Fed stepping in, and I think it's about, 2.6 trillion are the Treasuries now with the repo facilities and everything, those are done at zero, right? So regardless of the coupon stayed on there, it is zero. I mean, it's what a great scheme, right, to be able to do this. And so I think it's interesting, the negative interest rate component too, because I actually believe that it was a seminal moment in the market in December when the Riksbank from Sweden went from negative to zero. And to me, that's the biggest admission of there being some negative consequences. They go, the efficacy of the program has diminished. And therefore, we now have zero interest rates. We're still going to buy some bonds to kind of massage the market. But to me, that's the greatest admission of actually, from a central banker, to say it's not really working anymore. Mm-hmm. And I think that, with there being new leadership with the ECB, with Christine Lagarde taking over.
Is that really new? I mean, could you get any more of a same old than Lagarde? I think they just swapped jobs, didn't they? I mean,
if he ends up at the IMF, I'll agree with that. But what I'm saying is that it's someone different. And so different is how you can evoke change. And maybe there's a way to actually get them off of negative interest rate. I don't think it's politically popular. But at some point, having someone in the region actually admit that there was negative consequences policy, the best that they would ever do, maybe we'll see something. I don't expect it in the short term.
There was a really good lead article in Jim Grant's Interest Rate Observer. It's one of the publications that I read. I actually pay for it. It's the only research that I actually pay for, I think. Although I think we have some group things that we share. Yeah. But it's a great piece to read. If you're unfamiliar with Grant's Interest Rate Observer, you want to start with a dictionary next to you because he has a very arcane writing style. But he pointed out that there was some banker who was bemoaning the consequences of negative interest rates for the long term, but then he was advocating for another dose of further negative interest rates for the short term. It was right there, right next to each other, the admission that what they're doing is a horrible idea in the long term, but we're not in the long term, we're in today.
Yeah, well, I do know that the Lagarde has put forth this first policy revision kind of discussion in the last 16 years of discussing that. And it has been noted that there is the banking lobby that's saying, hey, we don't want negative interest rates anymore. Or we
of course.
I mean, the transmission mechanism has to change.
Banking lobby. I mean, I met with a senior guy from a very big Swiss insurance company, and he was pretty depressed. And he said, my life is just so terrible because our definition of success at our insurance company is drawing out the timeline to bankruptcy, because as long as interest rates are negative, that's our fate. We have no hope. And so it's interesting, one of the charts that I used in Just Markets, which is up on replay, you can see the charts there, is taking a look at the banking sector stocks in three major developed areas of the world: Japan as one area, Europe, and then the United States. And if you just go back to 1995 and just begin there with a unitize of 100 or whatever, United States banking stock index and the European banking stock index both had very sharp gains from 1995 into 2007. That was the big financial boom, obviously pre-crisis. Quietly, though, the Japanese banks did nothing but go down. Their high point since 1995 was 1995, and they did nothing but fall into 2007, while Europe and the US were enjoying probably, overextended gains and ridiculous
peak
activity.
Financial engineering.
Peak financial engineering. But Japan was dropping. Why was that? Well, because Japan went to zero and negative interest rates well before 2007. And so there's evidence staring you in the face that's bad for the banking sector. Then 2007 happened, and US and European financial indices dropped mightily. But then something interesting happened. The US bank index has gone up to match the high of 2007, is all the way back to the high, which might be a double top, who knows, maybe it'll break out, but it's gone all the way back up to the high. Meanwhile, the European banking system has done nothing but fall over that period and is now at the lowest level since basically the financial crisis. Mm-hmm. So, and of course, Japan has done nothing but plumb new lows all along the way. So why is that? Well, because Europe went to negative interest rates. And so their banking system, unlike ours, which rallied back to the old highs, did nothing but fall. So negative interest rates are fatal to the banking system. One thing I like about Jay Powell, and there's not a lot I like about his performance, given that you have any confidence that he's not going to completely change his mind in 6 weeks, One thing I like about him is he said at the press conferences in the middle of 2019 that when pushed pretty hard on negative interest rates, he basically said, no, I don't believe that that's a good idea in combating the next downturn or weakness in the economy. Hallelujah. What he did say is, I recommend large-scale asset purchases, which is the old trick, the quantitative easing.
Right.
Well, quantitative easing seems to have the effect of moving risk assets higher. That seems to be an incredible correlation. Also seems to have, kind of counterintuitively, the effect of raising long-term interest rates. It's happened every single time. When they did QE1, long rates rose. When they did QE2, long rates rose. When they did QE3, long rates rose. And long rates have been rising since September 17th, when they started this kind of, who knows what it is. They say it's not QE because it's doing increasing reserves and repo facilities and like and not buying long-term bonds. But long-term interest rates have been rising. In fact, German interest rates were at negative 70 basis points, and even they've been rising. They've made it to negative 15, and now they're at negative 25. And U.S. rates were down at 142 on the 10-year. They kept bumping into 195, and now they're in a range about 172 to 195, and they're at the low end right now. So it's interesting that quantitative easing has these effects, but at least we wouldn't go to negative interest rates. I hope the next Fed person believes that as well. They're getting a lot of pushback. Ben Bernanke is advocating negative interest rates now.
But it's amazing with Bernanke, because if you look at Bernanke, he's a student of the Japanese model. He's a student of the Depression, and he sees the data. But he still wants to say that it's contradictory. He believes in that policy.
Yeah, but let's just say, hopefully they can withstand the onslaught, because if the United States interest rates were to go negative for any length of time, it would be fatal to the entire global financial system, I believe. Right. Because it's one thing for Japan to be negative and Europe to be negative. If the US is still at something, 155 or something, at least there's somewhere for capital to go to not get destroyed. If the US joins, and the US is so big, so if the US joins them, there really is nowhere for capital to go, so it won't be destroyed. So one of the things I think that's been driving US outperformance and keeping the dollar somewhat stable over the last really 5 years, it's had volatility, but it's the same as it was 5 years ago, is the fact that capital comes to the United States because it has to flee these negative interest rates. Of course, US profit growth has been better. We had a big tax cut that improved the bottom line. There's a lot of reasons why the US stock market has outperformed the European stock market. But I think what's going on is they're buying US assets as escape from their own situation. And that has led to buoyancy in the dollar. In particular, Japan has bought, there's flow data on this, has bought a lot of US investment grade corporate bonds. And one has to believe that they're doing it without hedging the currency. Because if they hedge the currency, their yield advantage goes away. For most of the last couple of years, they'd have been better off just buying their own corporate bonds, and rather than buying US corporate bonds and hedging them back into yen. So they just buy them naked, which is incredibly risky, but there's things that motivate people to do investment activity. One of them is greed, and we all know about that one. One of them is fear, which we all know is stronger than greed, because the downside, markets take the stairs up and the escalator down, and the elevator down, I should say, because the fear is stronger than greed. But there's one thing that really crushes people, ultimately, and that's when they invest based on need. And I've seen people and institutions and the industry broadly do that a number of times over my 35 plus year career, and it always ends badly because they know that they don't really want to do it, but they don't have any choice. I can remember I was managing money for the University of Pittsburgh, and I was there with the treasurer, and he was in a bad mood, and I said, what's going on? I said, I just met with the president, and our operating fund is assumed to generate 6% for budgetary purposes, and the president asked me, how can I get 6%? And he said, we can't. We can't do that. We can really, and this was back when low interest rates was 3%. That's when short rates being at 3 was considered to be low. And he said, we can't do that. And he says, wrong answer. You have to do that. You have to get 6. So he ends up going out the curve, buying something out in 10 years, and lo and behold, 1994 comes, and he ends up losing a fortune. Why? Because it was based upon need. And when people buy things based on need, my experience is they have an unusually sensitive trigger finger when things start to go bad, because they don't want to be there in the first place. They knew it was dangerous, and now they have that crack of doom moment where they say, I knew this day was coming, and here it is. This thing that I did out of necessity is now turning on into massive losses. They end up reversing that trade because they're afraid that they're going to get trapped into further losses. So I think that that's a really big factor that has been driving things. And at least, as I said, Jay Powell says he's not going to go negative.
So let's take this back to something that you mentioned earlier, Jeffrey. The U.S. dollar has been, outperforming the rest of the world because we have positive interest rates. Let's just take us down the path where, Bernanke, who conveniently started advocating negative interest rates after he stepped down, but we have Pivot
Way
Powell.
after he stepped down.
Yeah, now we have Pivot Powell. You can't trust him out 6 weeks. Let's say he turns around and says, goes from, we're never going to go negative to we are going to go negative sometime this year.
Well, if he said we're going to go negative sometime this year, the U.S. dollar would probably drop 10% in a few weeks, because that's one of the major things that drives the dollar's interest rate differentials. And actually, that's one of the reasons why the dollar should probably be falling right now. I mean, the U.S. started easing in the middle of last year. There's a very high correlation to Fed easing and dollar weakness. And particularly when that easing isn't being, or in the present situation almost can't be, matched by other developed entities. Another thing that really correlates very strongly to a lower dollar with a lead time of about 20 months or so is the direction of the growth or shrinkage, and these days it's growth, in the twin deficits, the trade deficit and the budget deficit. In spite of what Trump campaigned on, he did throw tariffs on, but they haven't had the effect of decreasing the trade deficit. It's still going up. It's not going up very quickly, but it's still going up. And we all know, and we'll talk about this a few more times today, I'm sure, the national debt is going up at levels that should be raising serious concern. The growth in national debt in 2018 and 2019 was kind of equal as a percentage of GDP of the growth in national debt at the depths of previous recessions, brought on by the requirement of fiscal stimulus, which is basically you have to give out unemployment benefits, and your tax receipts are going down, so you end up stimulating through benefits and perhaps more TARP programs and stuff like that. And the dollar is incredibly sensitive to that over time. And so that national debt rising is really troubling when it's happening in a supposedly, well, I hear things like greatest economy of all time. In fact, I think I heard greatest economy in the history of the universe, I think came out, which is just so laughable. I mean, how about the economy was better 2 years ago? Let's start there. Forget about the history of time. How about the history of
of this administration, right? You got a better one
this
earlier,
administration. Right? So it is really concerning because when the recession comes, and it will, it's typical for the growth in the national debt to rise by about 4 percentage points. In fact, in the global financial crisis, it grew by 8 percentage points. So let's just say that's a bookend of badness, but let's just go there. That would mean that we'd be running about a 13-14% growth in national debt in the next recession, which sounds like a lot to me. So that would lead to an immense issuance of bonds.
It sounds like about $3 trillion.
And if you were really going old school and you're going to let about $3 trillion, and you're going to let the market set interest rates, where would long-term interest rates go? I mean, 10%? I mean, I don't know, some number that would just be so incredibly devastating and reinforcing the weakness of the economy. No wonder Jay Powell is going to do large-scale asset purchases. I think in the next recession, interest rates would rise at the long end if they weren't being manipulated. In fact, one of the most interesting things of the second half of 2019 was the fact that the repo market kind of blew up, the overnight market. On September 17th, the Fed funds rate was completely irrelevant to the overnight market. There was a moment in just a few hours that short-term money to actually clear the market. Banks had to borrow, regional banks had to borrow at around 10%, with a Fed funds rate at around 2.25% or so. That's really interesting because the 10-year Treasury yield was less than the Fed funds rate. The curve was classically inverted, with the 10-year yield lower than the Fed funds rate. If you can't clear overnight money at a rate higher than any other spot on the curve, it shows that there's not natural demand for that overnight money, that basically there's something wrong with the system. Now, the Fed says, well, what happened is we had tax payments in mid-September, and we had T-bills, not that many T-bills maturing versus those that we had to issue on the calendar. So, I mean, you didn't know that? You didn't know that there's a tax payment day, and you don't know what the Treasury calendar is? You got 700 PhD economists. I mean, come on. So they decided that they were short on reserves. That was clear evidence, market-based evidence. So they started a temporary increase in the repo facility, but don't you dare call it QE. And now they got the balance sheet back up to over $4 trillion. Ben Bernanke said that when we started QE1, that it's temporary, another temporary that turned into forever, and that we would be able to reverse it. Well, when the Fed tried to reverse the QE with the QT in the fourth quarter, second half of 2018, the entire market blew up. Stocks went into a bear market. The indices dropped over 20%. Junk bond prices were in the tank. There were 42 consecutive business days where the Wall Street was incapable of floating a single new issue junk bond. The market was completely closed because of the quantitative tightening and the rise in the 10-year towards 3%. I keep noticing that the market keeps throwing a fit at lower and lower and lower peaks of interest rates. And so it seems that the Fed doesn't have a notion that they can articulate as to what's going on here. That what is the temporariness of this plan? When are you going to stop it? Under what conditions are you going to stop it? Kind of reminds me, back a long time ago, I was doing reviews for institutional accounts in those days, and I went to one, and it was a highly unusual framework. There was the committee, the pension fund committee, and then there were the managers, and we were all sitting at the table together. And so the managers all heard the presentations of the other managers, which was kind of interesting. It probably changed their tone a little bit, having a competitor there. But it's really interesting because one of the firms, unfortunately for them, had really kind of disastrous performance. They had strayed far from their benchmark in ways that didn't help, and they just stood out like a sore thumb. And so the committee starts with them. And of course, you always start with the underperformer. You know, if you have 100 stocks in your portfolio and 99 are up, you know your client wants to talk about the one that's down, right? That's just human nature, the way it works. So they start torturing this poor guy, and they say, so what's going on here? We want an explanation. And the guy's answer was, you know, we're not really sure what happened here. In fact, we're just as confused as you are. And it's like, everyone's looking at each other like, oh my God, I can't believe this is happening. And of course, they fired him on the spot. It was just amazing. It was just like, I move to termination second, all opposed, done, right? That's the Fed. I don't know what's going on here. We're just as confused as you are, which is not a very happy message. But again, I say that the market being unable to clear at the Fed funds rate in the overnight repo market shows that there's not natural demand for the interest rates that have been set. And so there wouldn't be, I think by a factor of 5, it would be worse in the recession at the long end. So they won't let it happen.
But that's what they continue to do today. I mean, when they are asked about these temporary repo facilities, even Clarida comes out and says, oh, we have a plan to talk about it in a couple of months. And so it's exactly what you're...
How did that work for Elizabeth Warren? I have a plan. I have a plan.
Yeah, I mean, and it doesn't instill a lot of confidence when these are the people setting the policies. But it was interesting what you brought up about the fourth quarter, because all this destruction that market pundits were warning about, after all this and while this is happening, Jay Powell still raised interest rates in December of 18. And he said,
that's why the market just completely tanked.
Right, and he just exacerbated it. So I think they don't know what to do. And that's why I was saying earlier about the Reichsbank. To me, it's the closest thing as admitting that the policy is not working, is to say, oh, this efficacy has diminished. I mean, it's economists speak for the marginal utility goes away.
Right.
But really, at the end of it, what you see here is that if you overlay the balance sheet with risk assets, when the balance sheet goes up, risk assets perform quite well.
When the Fed is expanding the balance sheet, without exception, you've had strong risk asset markets. You've had rising long-term interest rates, you've had a steepening of the US yield curve, and you've had incremental weakness of the dollar every single time. And when they're tapering, ironically, interest rates actually go up, or actually go down.
Go down.
Go down. So they were tapering, doing quantitative tightening later in 2018 or 2019, and interest rates fell 100 basis points basically over the last 12 months.
Well, I think what you pointed out too, that we're near the low end of the range, let's say in the 10-year. I mean, if you look at the first couple of weeks so far, I mean, we've had, a strike on an Iranian general, right? We've
Which Iran didn't seem to mind very much, quite frankly, with their response being, incredibly cosmetic.
Yeah, but now we have this new coronavirus that's all over the news now. That who knows what that is? But I'm saying these fears that permeate through that, and you still don't really get a collapse and thing. So it just looks like there is this pressure on rates that you're.
Yeah. Well, whenever we think about where the 10-year Treasury in the United States should be, we start with a long-term signpost, which has worked amazingly well. And I believe that this chart is in my last total return webcast, and probably in Just Markets too. And what we do is we start, in the old days, it used to be that nominal GDP year over year was kind of a sensible place for the 10-year Treasury to be. And there's sort of academic theory that people throw out, economic theory about that. And that worked for a long time, but then it stopped working after the global financial crisis because suddenly US rates and German rates, to pick a placeholder, started to diverge. So for many years, they were largely the same level. And they started to diverge, so German rates went negative and US rates stayed around 2% or so. But now, you can take this back for 30 years, and it works remarkably well with incredibly tight correlation, except during recessions. If you take nominal GDP year over year in the United States and average it with the yield on the German 10-year, you average the two, you get an incredible electromagnet that seems to pull in the 10-year Treasury yield. So right now, nominal GDP in the United States is probably about 4.4. It's hard to know because it's lagged and all that, but it's around 4.4, and the German 10-year is at negative 25. So you average those together and you get about 4.15, right? So we should be at about 207, something like that. So 172 seems too low. Seems too low versus that thing. And also it also seems that interest rates may have bottomed globally on the 10-year. As I said, the German was negative 70 and now it's negative 25. So another thing that's shorter term on the US 10-year is the ratio of copper price to gold price, which is uncanny for the last 3 to 5 years in how well it works. And in fact, in late 2018, the copper gold ratio was plummeting while the 10-year Treasury yield was staying up above 3%. And it was sending a very strong signal that the 10-year yield was going to drop. And it certainly was a strongly positive signal. Right now, the copper gold ratio isn't saying much. It says the 10-year Treasury should be higher than it is right now. But probably by 10 or 15 basis points. But the two of them together sort of say that. Now, what I'd be really watching out for, if you really want to look for a reason, a signal to get scared on interest rates, it would be if the German 10-year rises above its nadir of July 2016. So what happened is the German 10-year went down to about negative 15 basis points or so the first time it went negative in July of 2016, and the US 10-year went down to 136 on a closing basis, 132 on an intraday basis. When the next low came on what was that, late August, early July of 2019, you had the German 10-year go to brand new lows of negative 70, and the US 10-year went to 142, did not go lower than the July 2016. The long bond, the 30-year Treasury bond, went to new lows below the 222 of July 2016, but the 10-year didn't. And those are things that you should look for. Those are called divergences in markets, where only one thing, one sector, one part of the yield curve, one index among many in, say, the United States, goes to a new low or new high, and nothing else does. So in the US, there was a big divergence between the 10-year and the 30-year. Internationally, there was that big divergence between the US 10-year and the German 10-year. Well, the German 10-year, if it now goes above, in other words, negative 15, so if it should God forbid, go to zero, which would be wonderful, I think. Then,
God forbid,
God
is
forbid,
wonderful.
it'd be wonderful. It would go to zero. That would be an incredible signal that rejects the entire basing of interest rates, and we're not very far away. We actually got there,
And we keep
right to that level last week, and it didn't break. So now it's eased off a little bit. But I would turn maximum bearish on long-term bonds if A, copper gold started to rise, and B, the 10-year German Bund went above the July 16. And by the way, I turned maximum negative on bonds. I think you were there on June 6th of 2016 when the 10-year was at 132.
Yeah, right.
I remember people were like, interest rates are negative. They're going to be negative forever. That was when interest rates being negative was a shock to people. I can't believe it. They're actually negative. We're in some bizarre upside-down world. Rates will never rise again. And they turned to me and they said, "What's your ranking on the bond market?" And I looked around and I said, because they were all capitulating. People on CNBC. There was a guy, and we're talking about rates low forever. There was a guy on Bloomberg News that said rates will never rise for the rest of my career, and I intend on having a very long career. This type of thing. Turned to me and I said, I want to be able to say to my grandchildren when they say to me, "Hey, somebody told me that there was this thing called a bond market, and you were like some guy that was like kind of known for doing this stuff in the bond market. Did you own those negative yielding bonds?" And I want to tell my grandchildren, no, I did not own those negative yielding bonds. I said, if this isn't a maximum bearish moment, I don't know what is. And but that would be how I would feel if A, copper gold started to rise, and B, you had the German 10-year.
You eerily
up that pivot.
You eerily had a lot of that sentiment in August of this year, in the first week of September.
Sure did.
Yeah, I mean, and people were one-upping each other with, yields are going to go to negative 200 and the Swiss curve.
It's not the negative 200 that always sends out a signal for me. It's when somebody who's been kind of fighting the market. They started out with rates are going to rise forecast. They were fighting it, and then they finally start getting religion of the consensus, and the 10 years at 142, and they say, you know what? I'm actually bullish. I think it's going to 135. Right? It's like, what kind of forecast is that? All right, you've been bearish for 200. You've been wrong for 200 basis points. I said now you're looking for this last gasp sort of a thing. You see that a lot too, where they get thematically in line with the consensus, but not really. They have some ridiculous, tiny little incremental forecasts. I remember when oil went down to $26 a barrel, and I think it was from like 90, right? It went from 90 down to 26 in
It was almost
part of
100.
2016.
Yeah.
And I know it was at 26. And all of a sudden, it was all oil all the time on CNBC. They had it on the screen for hours. I was at the New York Palace Hotel getting ready for the Just Markets webcast. And they're following it tick by tick. And every guest, they were talking about oil. And they came out and said, Standard Chartered Bank says oil's going to 20. From 90 to 26, and by the way, Standard Chartered does this all the time. After missing a huge move, they join the consensus. So one thing to look for is when Standard Chartered all of a sudden goes. But what even stupider is there was a competitor of ours on there, and he had been fighting it the whole way down too. And he said, my prediction, we are now bearish on oil. My prediction is going to 25. And it was at 26. And of course, it never made it to 25. That's the horrible part. Beauty of it.
Yeah, I remember too that during the whole natural gas glut that we had in the mid 2012, 2013. I remember some analyst came out with a negative price on natural gas.
That's
and
right.
I'm like, why wouldn't you just? I'm a big buyer at a negative price. First of all, you got to pay me to take it, and you can just burn it.
Sure.
Right. I mean, it's not like you have to store it. Right. I mean, it was really strange too.
Yeah, I remember. I vividly remember that as well.
Yeah. So.
Gentlemen, your honesty has left me quite frankly depressed here with all the somewhat negative news there.
No, but that's our job. People say, Gundlach, you always find like 7 risks for every one that exists. And I say, that's my job. It's to look for risk. A lot of people, what they do is look for non-risk. They see risk and they come up with some sort of a rationale for why it really isn't going to be a problem, right? So, for example, in the corporate bond market, there's always excuses now about why it's not overvalued, even though it is. You've got the junk bond people saying, yeah, the spreads are pretty tight. Yeah, we're late in the cycle. I got to believe that we're really not going to have spread tightening, maybe not price gains, but we're not really negative. There's selective opportunities. This is what someone who runs only a junk bond fund. There's selected opportunities, and we think it's going to be a picker's year, and broadly speaking, you'll earn the coupon. And you'll see a panel of 5 junk bond guys at a conference. They'll all nod in a north-south direction. Yep, we agree with that. We're right on page. Whenever that happens at a conference, that's the big sell signal. Because when the prediction is a coupon year and it's unanimous, that's everyone saying the risks are in plain sight. We just hope they don't land on us this year. That's essentially the translation of that panel.
Kicking the can.
The problem with that, though, this year is that it has to be coupon minus because, 70, I think our high yield guy put it together, it was like 71% of the market trades yield to call. So they don't even trade at par.
Yeah,
they trade above par. So by definition, you're not going to even get the coupon. It's even worse than just a true coupon.
Yeah, there's a risk that a lot of people don't really have the micro analysis to see, and that is what happens from time to time in the call risk of the bond market. In this case, it's the junk bond market, and that is that you're buying bonds that are trading to their call price. So they might have a call date in a year and a half. And so everyone's analyzing them as a 1.5-year security, and they're spreading them off of that part of the curve. But then when rates rise, all of a sudden maybe they're not going to be called. And now you have a 10-year bond. So you got something that goes up in price almost nothing for falling interest rates or improving credit situation, and a bond that drops like a 10-year treasury. Thank God the yield curve is relatively flat. Because if the yield curve were steep, it would be a double whammy. And I've seen this. I was talking to some young guys we were at dinner with, we had a partnership with last night. Young, I think they're 45 or something. I'm thinking of them as young guys now.
I call them peers.
I said to them, the worst thing that ever happened in the bond market, and I saw this explosion so many times in the 80s and early 90s, was telephone companies were able to borrow on a program of 40-year maturity, 5-year call. 40-year non-call 5. And they looked at me and said, what are you talking about? And so I had to explain to them that things were really that dumb back in the early days of the expanding debt bond market. And the problem with those bonds, of course, is 4 years into it, you now have a 36-year bond, non-call 1 year. And in those days, the curve was quite positively sloped. I mean, like 300 basis points, 200 basis points between like a 1 year and a 30-year. And these things would trade to call like 50 basis points over the year bill. And then we used to have big rate spikes back in those days. And then rates would rise like 200 basis points. And they'd roll up the curve 200 basis points, no longer any chance of a call. And suddenly they're priced as a 36-year bond, 400 basis points higher yield from where you started, which is a loss of like 40%. Right? So I've actually been thinking about trying to issue some of those. Because if the young people aren't aware of the dangers, and people fell for it before, right. So I'm actually thinking of floating some DoubleLine bonds. Yeah. 40-year non-call 5. I'm serious.
Yeah. I mean, if the Treasury can't do it, might as well start.
But that's a big risk in the corporate bond market. We've talked about this in webcasts before, but the corporate bond market appears to be misrated in the BBB sector, which is more than half. The corporate bond market has exploded in size. It's now $8 trillion. And the junk bond market has not really grown. It's been refinanced into bank loans, and it's hasn't had the same time. There's been some upgrades. But the corporate bond market strikes me as being highly worthy of avoidance. It doesn't really matter if it does well this year. It's one of these things where when it goes, it's going to go at a magnitude that you don't want to be trying to scrape out an extra 50 basis points. Do you know the BB junk bond market as a complete sector, 2 no losses? Does anybody know what it yields, BB bond market, 2 no losses? Some people think, wow, 5? I mean, that's really low. 4.5, 4.25, 4, 3 3/4. Keep going. 3.5. It's about 340 to no losses. I mean, why wouldn't you sell those and just buy stocks? I'm not really bullish on stocks, but why wouldn't you do that as just a swap trade? Because the stocks can go up. The dividend yield is probably, what, 180 now or something on a lot of stocks. Yeah. So, okay, you're giving 160 basis points, but it seems to me that you're going to have no upside and probably about the same downside. When the recession hits, stocks and junk bonds will probably have similar returns, at least in a short-term window at the beginning of the problem.
Yeah.
So I'm going to make one more attempt at this. I'm going to add to your job description, Jeffrey, and then also for you, Sherm. Let's find some opportunities out there. Where are the opportunities that are perhaps being overlooked? And how should people be thinking about the next?
All right. I think that it's pretty impressive that with the dollar having very little variance over the past 18 months, or certainly over the past year to date, it's kind of interesting that gold has gone up to 1550. And I think that that's telling you a lot about people's gradually changing their attitudes about things. So since I believe that the next big move in the dollar is down, and the dollar has already done well, gold has already done well with a stable dollar, it just seems that gold will ultimately break out and could do quite well. Commodities broadly are wickedly cyclically cheap versus equities right now in the United States.
Today.
In the United States. I mean, they're getting pummeled today. Yes, absolutely. Yeah. You know, someone has sold out of those face masks and stuff. So if you look at, there's a chart that's gone around a lot, and it's disappeared. It was popular a couple of years ago, and that is comparing the market capitalization of the S&P 500 to the market capitalization of a Goldman's commodity index. And it moves in very big swings, and pattern repeats itself a lot over the last several decades. And that is, there are moments where commodities underperform by 8x, and we just had one of those, and then commodities outperform by 8x. And if the dollar actually does get weak, you'd probably be in one of the potential commodity outperforming. Also, I think you're supposed to be on an asset allocation basis. I'm not sure this is going to make you absolute returns. But I've got to believe that you're better off in emerging market equity, and you might not want the serial defaulters. You might want to kick those out. But then you would be a basket of emerging market equity as opposed to the S&P 500, because that valuation, A, is incredibly cheap versus the U.S. The CAPE ratio on emerging markets is about half that on the S&P 500. But more importantly, it's not underperforming anymore. The top of the global stock market was actually January 26th of 2018. The global stock market ex-US has been down for the last 2 years, basically. Mm-hmm. Then the US market went to a solo peak on October 3rd of 2018, and some of the indices have taken that top out, like the Dow Jones, the S&P, the NASDAQ. The transports have not. The New York State Composite, Stock Exchange Composite has not, and Russell 2000 has not, I don't think. So, but interestingly, so after October 3rd of 2018, all of the stock markets dropped with the Fed doing their bad deeds in the fourth quarter. What's interesting is during that decline, emerging markets actually outperformed the United States, which is highly unusual. They tend to be higher beta, and they tend to therefore drop more when the bad time comes. And by the way, over that time period, the dollar did not drop either. So it wasn't like a dollar drop somehow helped the relative performance of emerging markets. Since then, there's been a lot of fluctuation. Again, the U.S. has gone to new highs. But the U.S. hasn't really outperformed. The S&P 500 hasn't really significantly outperformed emerging markets since that October 3rd, which is interesting because it kind of shows a trend change that's living below the radar. Mm-hmm. So it looks to me like emerging markets have turned the corner and are now matching, not month to month or quarter to quarter, but since October 3rd, 2018, matching the S&P performance in an environment that doesn't particularly favor it. Because the U.S. economy has been stronger than many. It's been stronger than the global economy, et cetera. So I think the setup is there that on a risk-reward basis, you're probably going to be better off in relative performance in EM. I wouldn't buy European anything. I mean, I just think the demographic problem and the Eurozone staying together problem is just forever intractable. So I would stay away from that, but I would be more inclined. I wouldn't mind Japanese stocks. I mean, they're going to be QEing forever.
I think that if you're going to stay on the relative value theme and you kind of bashed the high quality junk, the double B corporate bond sector, what's also interesting if you look at it, and there's some compositional differences and credit quality differences, but if you actually look at the aggregate bank loan market, we've been looking at this in the macro meetings, that the bank loan market, which in general is senior and secured, okay, yields more today than the subordinated unsecured debt in aggregate of the high yield market.
Right.
What?
Yeah, that doesn't look right.
You know?
It seems to me you should be barbelling. If you're going to own credit, because people often do, it seemed to me you would stay away from double B.
Yeah.
And we've actually tend not to be, fallen angels buyers or real risky buyers of anything, but we have been downgrading our junk bond holdings because the triple Bs are so expensive.
Yeah.
We don't have a lot of junk bonds in like our core funds, but we do own some because the low tier sector did terrible last year. Did horrible. It was the worst performing part of the bond market. That means there's opportunity.
I was doing some reviews with clients in the first week of the year and talking about opportunity set. And I said, do you have any idea what the triple C bank loan market yields? Because we did all this stuff about the double Bs.
Defaults,
yeah, there's a lot of defaults. There's a lot of problems. It's concentrated a lot in tech, telecom, and energy. Right. But at the beginning of the year, the spread was 1,800. And so I'll speak stock term. That's 18% spread over LIBOR. Now it's tightened in a fair amount. It's probably 1,500 today. So that's a big move in roughly 3 weeks. But the idea there is there are things you can buy that have yield. Now they have stories with them. They have hair on them. So people have been hiding out. And so something that we were trying to acquire more of in the fourth quarter was CLO. Because we liked kind of this idea of certain pockets of the bank loan market, and it's hard to buy. It's very difficult for retail and people to get their hands on. But you can still buy out there. You can buy triple B CLO. It's not equivalent in terms of loss profile as a triple B credit, but it still pays you in the 5 handle.
And if you're an adrenaline junkie, which I'm not, I think you could. I think, and I hate Bitcoin. I just hate the whole story. But I actually think Bitcoin will go up. I think you make 20% on Bitcoin pretty easily, just because it's a complicated story. But the way it ebbs and flows and the way the narrative evolves, it seems like it's back. It's got a little mojo going again.
And it's pretty correlated to the Fed's balance sheet.
It's pretty correlated to the Fed's balance sheet, and gold has gone up as well, which kind of fits together in the puzzle of the narratives underneath the surface. There's some shifts going on in the way people think. We also think that the TIPS market is a little bit more on the attractive side relative to nominal treasuries. One of the reasons why is it seems clear to us that now if oil's been dropping a little bit lately, but it seems to us that if oil can find its footing at $60 a barrel or so, which has been kind of a central tendency point, that the CPI is going to be about 2.5% in 2020. It's at 2.3 now. We don't really see much sign of it going down. I have a fun fact to know and tell. This is really interesting. One of the things that we're always trying to grind out original charts that tell interesting stories and maybe give us some information. We compared the 30-year mortgage rate history, going way back to the 1970s, to year-over-year average hourly earnings of the non-supervisory area, which was up at 3.7, believe it or not, last month, and now it took a huge drop from 3.7 year-over-year to 3.0. It's kind of hard to understand why, with our analysts looking into how it can move so much. It's not so much the one rolling off either. But what's interesting is over that huge period of time, until recently, the mortgage rate was always higher than average hourly earnings, except for one point in the mid-'70s, when there was one moment where finally the average hourly earnings went over the mortgage rate. And right after that was a 1,000 basis point increase in interest rates. It just happened again for the second time in history. Now, one sample analysis, one data sample is always suspect, but I just find it a fun fact to know and tell. The relationship of interest rates on Fannie Mae commitment rate and average hourly earnings just sent the same carved out the same pattern is exactly the one that preceded the great bear market in bonds. Doesn't mean it's going to happen, but it's probably worth tracking. It's a couple of things, speaking of which, worth tracking. I always begin my macro analysis of the biggest question about portfolio allocation is, do we see a recession coming? And in the manufacturing sector, we're in a recession. The PMIs of manufacturing look terrible. But some of the really key things are still holding up. One other thing we look at is leading indicators year over year, which are now at 0.1 year over year. They were at 6.5 year over year 18 months ago. 0.1, that's really bears watching, because every single recession has had a necessary condition of leading indicators being negative first.
I hate to inform you, but it went to negative 0.3 today. The new
Oh,
data point came out today.
It said 0.1.
That's negative 0.3.
Well, there it is, negative 0.3. So now we're on recession watch.
As of right now.
As of right now. Okay. That's interesting.
Was that on the month-over-month?
No, that was the year over year.
I think that was month over month. Anyway, it doesn't matter. We're very close to zero. And the point is that every recession is preceded by leading indicators going up. You do get negative leading indicators without a recession. So whether it's 0.1 or negative 0.3, it's probably the same thing from this analysis. Now, the other thing that we look at, which is almost game over for recession, is consumer confidence, which ties into initial unemployment claims. So we start with consumer confidence. Consumer confidence, they ask different questions. One of them is, how you feeling about today? And consumers feel great about today. Those surveys are at the same levels as 1999 and 2007, which might be good, might be bad, but they're holding up. The key isn't really the level. It can get to a high level that looks like prior peaks in risk assets, but they can stay there, just like that's been the case here for a couple of years. Consumers feel very, very comfortable about today. However, starting about a year or so ago, maybe 2 years ago now, they also asked the question, how do you feel about what's coming at you 12 months from now? And about 18 months ago, the answer to that question was, I feel horrible about what's coming in 12 to 18 months, just about as bad as you can. So the gap between today and 12 months from now is very large, and it's exactly as big as it typically is before big recessions. Now, the good news is that there's a lead time on this. It can stay at this level and precede the front edge of the recession by 2 years, 2.5 years. So that's the good news. What you'll watch for is when the viewpoint of today deteriorates down and starts to look like the future, so that that big gap goes to zero, that almost definitionally says you're headed, if not already, in a recession. Now, what would cause people to feel lousy about today? Their neighbor losing their job, right? That's what makes people feel bad. They're the guy at the cube next to him losing his or her job, the person next to him, right? That's what they would feel bad about. So what you have to watch is weekly initial unemployment claims. One thing that we've found is that it's almost a slam dunk if the 4-week moving average of initial claims, we use a 4-week moving average because they bounce around, so it's a little bit dicey to use just one data point. And we compare it to the 5-year moving average. And almost definitionally, you can see why. If you have the 4-week go higher than the 5-year, something bad is going on, and people are losing their jobs. Well, when that crosses over, it's game over every single time. And it's really, we data mined this, I'll admit that, but it's weird how well it works. And this goes back decades, that it's right when you get that crossover that it's front edge of the recession. Now, good news is we just got an initial unemployment claim. It wasn't bad at all. In fact, it was quite low. Yeah. So the moving average right now is about 240,000, that longer term moving average. And the prints are coming out at around 210, 215 these days. I think there was, at year end, there's some noise, particularly when the holidays move around and stuff, short Christmas season, all that stuff. But that's really bears watching, because then that's a really good, fast, high frequency indicator. It's weekly data, so it gives you a good heads up. Right now, no problem there. So our idea of a recession in 2020 is not really worth much, because it's almost exactly consensus. It's really at about 30%. So it was a lot higher than that in the summer, when white papers were being written that the Fed needs to do an intermeeting 50 basis point emergency cut. That's how dire the situation was. That's what got the 10-year to 142. Mm-hmm. But those are things that are really bear watching.
And I've been thinking about it. Sam's right. It was the month over month was negative 0.3. The year over year is negative 0.1. Yeah, that's right.
Okay.
Yeah, so, but it's rounding.
Anyway, the absolute value is 0.1.
Yeah.
That will agree.
There you go. Yeah, we'll agree on that.
Well, gentlemen, this has been incredibly insightful. We pushed a little bit past the 1 hour mark for this. And before I let the audience chime in with questions, we should have someone around with a microphone. So if you do have questions later on, you can raise your hand and someone will come through. But before I let us transition into that segment, I'm going to put you through a little bit of Sherman Says. And for the audience, if you're not aware of this, we do have this on their Sherman Show podcast where Sherman calls it my favorite part of this segment. And what I'll do is I'll offer up a series of prompts alternating between Jeff Sherman and Jeffrey Gundlach, to which they'll provide a top-of-mind response. So let's start off with Sherman with autopilot.
Scary.
Fed repo facility.
Broken.
Montana or Young?
Montana.
Jim Kelly.
Hall of Fame.
S&P earnings 2020.
4.
Number of years it's going to take the Buffalo Bills to finally win a Super Bowl.
It's either 2 or 3.
That close? All right.
Yeah.
All right.
So the Niners, it takes what, 2 weeks? 2 weeks?
I like
Save that
I like
answer.
the underdog. I like the Niners.
Yeah.
I think they're fundamentally a better team. And I don't like the razzle-dazzle stuff. I mean, you mentioned Jim Kelly. Jim Kelly and the Bills back in the early 90s was all razzle-dazzle, right? Long bombs, K-gun, hurry up. And they couldn't get to the top of the mountain. I just the razzle dazzle. I don't know. And something about people like, wow, they Kansas City, they came back from 21 and 17. I don't think spotting other teams 2 and 3 touchdowns is a sign of a good team. So
Hey, if you can run for 250 to 300 yards a game, it's hard to beat.
Yeah, Garoppolo. I don't know if he's any good or not because he doesn't ever throw the ball. They ran it 8 times.
Yeah. He passed 8 times.
Passed 8 times. Yeah. That shows you what they got going on, and their pass rush is going to be a problem for Mahomes. Yeah.
All right, let's continue the theme for Sherman, Chicago Bears.
How'd I get that one? Yeah. Yes. Thanks for Robbie Gould. Thank you. How's that?
Yeah, all right.
Well, didn't the Bears score all the points? Our local guy, Nick Dalgetti, told me that every single point that was scored last week was scored by a former Bear. And so you should know Rostar.
You know what the answer is for them? Maybe they'll pick up Brady.
Yeah.
Right?
Could be. Some play.
Well, Phillip Rivers is in play, too. Anyway.
Art Institute of Chicago, Jeffrey.
Warhol.
Euro for Sherman. Euro, not Euro. Euro.
Like the sandwich?
Not like the sandwich, like the currency.
Buy it.
Globalization.
In reverse.
Favorite sandwich.
Hero.
Nice. Favorite soup.
Manhattan clam chowder.
All right.
Manhattan. Huh? Tomatoes.
It's a lot of
Sounds
salt.
pretty good.
A lot of salt.
All right, with that, do we have any questions out there? I'm sure there is at least a few. I think I see someone in the front row here.
Sam, right here.
Oh, okay, sorry.
Thank you for your time. With the transition from LIBOR to SOFR, I say SOFR in Chicago, what do you see the implications to the bond market overall, and how does that factor into your portfolio strategy?
Zero. I think it's telling that with all of this noise going on in the short end of the market, last time I checked, one week LIBOR and 1 week SOFR was exactly the same to the basis point.
Yeah.
So it just seems to me that it's sort of a Y2K thing. It's something that people ask a question because it sounds like something you're supposed to ask a question about. But I got a letter. This is absolutely a true story. I got a letter in 1999 from a client saying we need a lettered affirming that your parking lot is Y2K compliant. It actually happened.
No computer, and it's got to be fine. Right?
Unbelievable. I just didn't know what to say.
Well, I think to your point there, too, it's going to be LIBOR again. It just has a different name because I equate it to AIG, right? AIG is still in business. You just don't necessarily want to be borrowing from them, right? So you just have to change the name of it. And so that's all that's really happening. And it's let the other countries name their own. So like in the UK, it's Sonia. It's exotic names, and we got SOFR.
It's like Long Island iced tea. They had a day in the sun when they named the company Long Island Blockchain.
Yeah, I remember that. Yeah. It was up like
Stock
3x, right?
Stock went up 400% that day.
And I think we have one right there.
Oh, but the winner in the LIBOR to SOFR change, lawyers.
No.
I was in Zimbabwe a few years ago and have $65 trillion of Zimbabwe, which cost me about $3.
I've got some right here. I got some right,
Overpaid on that today.
How big a denomination?
right here. Somebody gave this to me after an event like this. He said, "I want you to have this. You want to look like a hot shot in a bar. You pull this out. $100 trillion. $100 trillion. You can buy it on eBay for about $5.
And I have two on my desk at the trading desk. So I'm twice as wealthy as him in Zimbabwe.
Whatever comes back.
Liquid.
You know, that kind of proves that debt matters, and it proves that you can't print your way to prosperity, right? If these statements are becoming increasingly consensus thinking, that actually we've been wrong all along, debt doesn't matter, and yeah, it's because we have our reserve currency, we can print it, modern monetary theory. Why isn't Zimbabwe the most prosperous country in the world if that's true?
My question is with velocity. You know, velocity drives it. Once velocity ticks up, they got to claw back the money, right?
Yeah, it hasn't happened.
What will drive it? What will change it? Just if we go over the top,
Why does it have to change? I mean, look at debt velocity. Forget the monetary side, just the borrowing, right? You see that in the government, what we just talked about at the very beginning, what I led with, right? You're talking about GDP growing half or 35% of what the debt grew at. So that tells me that there's not even debt velocity either. And if you look at M2 growth right now, monetary growth is like 8-9% right now. And that's because of how much liquidity is being pumped into the system. And so I don't know if the velocity equation is broken, if we had an aberration in the 90s, in the late 90s, early 2000s that makes it look like it's broken, but it's obviously not working. That's why we have to have larger and larger deficits as a percentage of GDP to get any kick, to get us our 2.3% real growth rate.
I think there has to be some sort of a link in between monetary velocity and debt velocity. And I think that's I think it's sort of two sides of the same coin.
Yeah, hi. Since we're in Chicago, if you had the opportunity to have a private meeting with the mayor of Chicago and the governor of Illinois,
I probably could if I wanted to.
What suggestions and ideas would you have for them for our horrifically and pathetically funded pension funds in the state and city?
Start building the case for a federal bailout, because I don't think there's any way out without a bailout. You're in a negative underwriting cycle of huge magnitude, and like so many other pension systems, the payments aren't there. That's one of the reasons why the United States has unfunded liabilities across all areas of the economy that are 600% of GDP. One way to think about that is if we wanted to actually pay those off, we would have to take 10 points out of GDP for 60 years. I mean, it's a 2 or 3 generational depression, and obviously that can't happen. So it's all going to end up in debasing or defaulting on those claims. And I don't really understand why we don't default on Social Security. And what I mean by that, years ago, before the financial crisis or during it, I used to say, I think we're going to default on Social Security. And there'd be a gasp in the room. And I'd say, well, how many people think that we're going to have to raise the eligibility age for Social Security? And a whole bunch of hands go up. I said, well, that's a default. That is a partial default. If your eligibility age is 65 and they change it to 75, that's a 10-year default. That's probably a 50% default on what you're owed. But I actually think that's a really good solution. And, people are living a lot longer. People are forced to work longer. I don't know. I think that there will be a combination of, adjustments. And the baby boomers are a very different generation. It's not typical in history for people to start dressing weird compared to their parents and trying to move out. And, they had the Vietnam War and a lot of motivation and a huge demographic bulge that, safety in numbers and all that. But multi-generational households are the norm through history, and they're coming back again. And the Xers and the millennials, they don't hate their parents.
I like them.
They like them. They stand in line at the Apple store together. They wear the same clothes. You know,
They're Twitter friends and Facebook friends.
Right. And so I actually think the boomers are the weird ones. And they're pretty docile at the end of the day. I think that there'll be a small resistance to defaulting on entitlements. And then when everyone realizes that there is no other road other than monetization and hyperinflation, that they'll probably be relatively docile and go along with it. But when it comes to states, I don't know. I mean, you either have to get bankruptcies to be legal, or you have to get a government bailout, because you ain't going to pay it in real dollars. That's for sure.
With an equity focus, I would be curious as to your thoughts regarding the growing influence of the index fund industry in
Sure.
terms of when you pull up a value line report, you see BlackRock, Vanguard, 7 to 8% of major S&P 500 companies, and they're blind purchases. Well, oftentimes through 401ks, target date funds don't take into consideration fundamentals valuation.
That and robo-advisors kind of fall in the same category, and that's herding mentality. And particularly for the index funds, it's momentum investing. There's nothing more definitional momentum investing than indexing in equities, because you're buying more and more and more of the stocks that go up the most. So it's pure momentum investing. And obviously, momentum investing has worked very well in the United States. So it's one of these things that fuels volatility, happy volatility to the upside, and then fuels unhappy volatility to the downside. It's just classic unwinding and herding mentality. When it comes to indexing, what's fascinating is that in the mid-90s, everybody wanted to index their bonds, and nobody wanted to index their stocks. And the reason was that the bonds were working. And people didn't like, having to try to understand weird nuances of underperformance from active management. All I had to do was buy the Barclays, then the Lehman Aggregate Bond Index. So you would go to a pension committee review, and they'd say, oh God, here comes this painful moment. We have to talk about the bond market. Okay, let's go through our fixed income stuff. Okay, 1 year we did 8, 3 years we did 8, 5 years we did 8. Our actual rate assumption is 7.5. Any questions? Good, we're done with the bonds. Let's talk about PE. Because it was working. It was weird how, as the rate was below 8, there was a capital gain that kept showing up, that kept it at 8. So people were looking at active management. There's a lot of volatility in the stock market in 99 and so on. Well, look at what's happening now. Now there are some people that are indexing bonds. I know the Vanguard Bond Fund, which is an index fund, just continues to draw. It's probably a lot of this automatic 401k type of stuff. But nobody should really want a bond index fund. I mean, it's the Sherman ratio, which is the duration and the volatility, or the yield and the duration. So it's you divide the yield by the duration of the bond market's about as bad as it's ever been. And what I mean by that is the duration. So your interest rate risk is about 6, and your yield is what, 2.5, maybe if you're lucky now, maybe 2.30. So the ratio is not very good.
Good news is it's better than the global ag.
Yeah.
Right? Global ag yields I think it's
horrible.
Probably like 25 basis points.
Yields like 15. I think ex-US is 15, I think. But and I think the duration is like 7, 8.
The duration's a year and a quarter longer.
Yeah, a year and a quarter longer. So in the bond market, weirdly, I think it's cooled down. But a couple of years ago, all the rage was uber active management. Unconstrained. It used to be, okay, index fund, core, you can do this, core plus, and then it was suddenly, I'm going to close my eyes and cover my ears and hum. Don't tell me what you're doing, but you can do anything. Please don't tell me what you're doing, because I'm going to be scared to death of what kind of risk profile I have. So unconstrained, anything goes, negative duration, positive duration, 100% credit, shorting the market, you name it. That was highly popular, sitting right next to only indexation in stocks. It's interesting, right? These exactly contradictory mindsets sitting side by side with each other. Mark my words, in the next recession, indexing will be considered to be a 4-letter word in equities.
All right, we have time for 2 more questions. I know we do have one up in front that's been patiently waiting. So 1 and 2, please.
Just a quick question regarding the Fed. It seems to me that due to the excessive debt we currently have. And as you mentioned, the increasing sensitivity to lower and lower rates, the Fed's hands are being increasingly tied. Two questions. One, what do you think the Fed should be doing right now? And number two, what do you think they will be doing? And how is this all going to end in your mind?
Well, should is always a tough one. When you've boxed yourself in a corner, it's kind of like I get asked questions sometimes. Wow, I was at a conference you spoke at 2 years ago, and you were so right on that one recommendation, but I stayed in that sector and I'm down 70. What should I do now? And I'm like, go into a time machine, right? Just like you got a cab driver, it's like, I'm going to retire in 3 years. I have only $500. What should I do? You're an investment guy. What should I do? Go into a time machine and start saving at age 20. That's what you should do. What should the Fed do at this point? I think they should get out of the way of the market and let it all happen. But they're not going to do that. They're going to continue to try to sustain the economy as long as they can. They've said so in plain English. And that means that every time we get a little weakness, and maybe we're getting a little now. I mean, GDP now from the Atlanta Fed is at 1.7. I don't know if it came out today or not. Is it 1.7? I mean, that's for the fourth quarter, right? Fourth quarter is usually pretty strong seasonally. So that's not a good sign. So I don't know. But the Fed is obviously already in QE mode, and they'll do more of it, I think. It's interesting. When the Fed started QE, they dreamt up that term because they didn't want to call it monetization. They were embarrassed to call it monetization. Now they're embarrassed to call their balance sheet expansion QE. So they're calling it reserve building, excess reserve increase. Well, what will it be next? We're not going to call it QE. We're not doing QE. We're not doing reserve repo. We have a new term for our Fed activity. It's called good stuff. We're doing good stuff.
Maybe they'll call it indexing.
I would say the press conferences would go a lot easier.
Yeah. Well, Jay Powell has gone from really trying to act like he was steady hand on the tiller back in 2018. It didn't work. The market laughed in his face. To now trying to put a couple of press conferences together where he doesn't contradict the previous press conference. And he's done that now for about the last 4 or 5 months. So he's trying to shrink he's trying to shorten the game at the press conferences. He's running the ball.
Yeah. Works.
Yeah. He's getting better marks.
But remember, it's not just the Fed, it's the coordination globally, right? You have the ECB doing the same type of policy, the BOE doing the same thing. You have the BOJ. So it's not the Fed on this island by itself. It's that these masters of the universe, it used to be the fund managers or the hedge fund managers. The masters of the universe are 4 of them, right? They're the heads of the 4 largest central banks around the world, and they all have the same mission. They want to prop up asset prices. And so until that breaks, it's hard to see them doing anything different.
One thing that seems to be a motivation is the fire trucks in the ECB and around the world seem to come out when you get yet another swoon in Deutsche Bank stock. It's down so much, and it hasn't rallied hardly at all in percentage terms. It has, but I mean, but basically, there's something about the bank with your country's name on it looking like it's bankrupt that gets people worried. And in the United States, that happened. Bank of America went below 10, and that's when all the bailouts started coming. And Deutsche Bank is now just living firmly below 10. I mean, they fought that 10 barrier. They were intervening like crazy, buying shares and all this stuff. And then finally, they just had to give up. And it went down to about $6, $6.50, something like that. And it's rallied with higher interest rates, which makes sense. It's up to about 8.5, which is a pretty big percentage rally. But please, don't try to tell me you would have caught 6.50, right? So if you want to bet on higher global interest rates, I think the very best way to do it is to buy Deutsche Bank stock. I think if you really believe, if you come to believe that interest rates are going to go to zero in Germany or go positive, Deutsche Bank stock will probably go up 100%.
Well, 18 months ago, it was positive 70 basis points on the German 10-year, right? Yeah. I mean, it's not that outlandish to think it could happen.
Right. So that's an interesting. You say, what are opportunities? I mean, I hate Deutsche Bank's bad loan position. I mean, they've got to be underwater, but and bankrupt. But I don't know. It just seems to me that it's just a timely type of speculation.
So on the your outlook for the dollar obviously is down for a variety of reasons.
On the next big move, yeah.
And so obviously that's going to help the emerging markets. It's also going to help the commodities. So from a perspective that a lot of these emerging markets are very commodity driven, that should help.
Some are. That's a little bit of a anachronism, but there is merit to saying they are commodity, but not all of them are really that much commodities anymore.
So in that scenario, from a perspective of maybe getting help from two different areas, is the approach best to buy the emerging bonds or emerging stocks?
I think emerging stocks look better, but in a bond market context, emerging market bonds look fairly good. I mean, they did really well last year, which is not a reason to like them now. But it's interesting that they are doing well. In the year broadly last year wasn't all that great. I mean, the dollar went up 25 basis points. That didn't help or hurt really. You had some really big problems down south. Yeah. Right? Some really horrific negative numbers. But I think emerging markets are in better shape, frankly, than developed markets in terms of kind of fundamentals of demographics, indebtedness.
They've defaulted more recently, so they have a better fiscal position.
I mean, it's really, the fundamentals are really better. And fascinatingly, the emerging markets are way down in volatility over the last several years versus, say, the 90s. Way down in volatility. So the Sherman ratio on emerging markets is pretty good if you think about volatility and not duration. Yeah. Right? If you just take a look at what the actual Sharpe ratio, I guess, has been, or you can, on a prospective basis, say sort of a adjusted Sherman ratio, it's way better than it's been in the past, even though the spreads are tight. And there's been a lot of upgrades in emerging markets, yet the spreads are kind of where they've been. They're kind of at the central point. They're a little on the tight side now, but they're sort of at the central point of around the range that they've been in for years.
But the spreads are comparable to high yields, and you have a better composition on credit quality.
I think the spreads are wider than high yield.
That's what I'm saying. They're better than.
Better than. Right, and the volatility realized volatility has been less. It seems to me that that's a reasonably good place to be.
Well, thank you, Jeffrey. Thank you, Sherman, for all your insights tonight. We're going to close it off there. We're at the top of the hour mark. As Barb mentioned, it's been an exciting time. We just passed our 10-year anniversary, and we look forward to the next decade or decades of continuing to earn your trust here with DoubleLine here. So definitely appreciate all the support from the people in this room. Would like to invite you now it's a cocktail hour or hours, one of those two, but please have a drink. Come up, talk to people, and say hello to those that you don't know. Thanks, everyone.